Hey, I'm Paul Rabalais, and in this video we are going to talk about the Bernie Sanders wealth tax plan. Alright, so I'm an estate planning attorney to help our clients get and keep their legal affairs in order, and at the time that I'm making this video, Bernie Sanders is the starting to maybe separate from the Democratic pact a little bit as the leading front runner for the Democratic nomination for president. So started digging around and just kind of for kicks, seeing what would our tax situation look like under a Bernie Sanders presidency. So let me give you the basics. Right now, under our current system, and let's talk about the wealthier folks. They pay income tax on their income. They pay capital gains tax when they sell appreciated assets. And their estates pay estate tax when they die. So income tax, they pay income tax at about a 40% federal rate. They pay estate tax on the fair market value of what they own when they die, 40%. And so now let's take a look at what some of Bernie Sanders' plans are. And so I really pulled this from the Bernie Sanders website. So I'm sure that every candidate, when they put their tax proposals on their website, they're kind of written through rose-colored and looked at through rose-colored glasses, or however they say that. So they try to make it not look too bad. That's why it's called the tax on extreme wealth on Bernie's website. So what Bernie proposes is what he calls a wealth tax. The United States of America has never had a wealth tax. We have an estate tax, which is completely different than a wealth tax. And a wealth tax is completely different from an income tax or a capital gains tax. The closest thing to a wealth tax is perhaps the estate tax. The estate tax applies when somebody dies and the government says, give me 40% of your estate. That's the estate tax. And you have to add up the fair market value of everything that person owned, their land, their businesses, everything they owned, and multiply that by 40%, and then send the IRS a check for 40% of the fair market value of one's estate. Currently, there's the first $11.58 million of an estate is exempt, and then the tax applies to the amount in excess of that $11.58 million. And that's, again, it's a one-time thing on estates when somebody dies. Now, the wealth tax is different. The wealth tax is every year add up the fair market value of everything that you own, determine your net worth, and then apply a percentage, multiply that by the appropriate percentage, and write a check to the government for a percentage of your net worth. Not your income, not capital gain when you sell something, just a percentage of the fair market value of what you own, and do it every year. So the way that wealth tax works, looking at Bernie's website, is it applies to people who have a net worth of over $16 million. And the wealth tax starts at 1% and goes up to 8%. I think for people who have a net worth of $1 billion or more, they'll be at that top 8%. So just for kicks, I said, well, let me do a little math for just some really crazy wealthy person. Maybe we'll call him, Jeff Bezos, who, built Amazon, which actually provides, built it by kind of working his tail off and providing value to customers like me who like to use his service. And he employs one heck of a lot of people. In fact, I read something the other day that says Amazon is looking to hire somewhere like 30 to 35,000 jobs. That's a lot of new jobs. So how would Jeff Bezos, if he had, let's say he had a net worth of $100 billion, and let's say he just shuts it down when he's 65 years old, says I'm retiring. I got my $100 billion. I'm gonna sit on it, and I'm going to enjoy the rest of my life. And let's say he has no more income for the rest of his life, but he's got $100 billion, so that's okay. Well, so under Bernie's plan, the year he retires when he's 65, he's going to write a check to the IRS for $8 billion. $100 billion, 8% wealth tax. Now he's down to $92 billion and he's 66 years old. Here's another check, 8% of that, 7 point something billion, writing a check to the IRS. Next year, another 7 point something billion, writing a check to the IRS. Again, no income, no capital gain, nothing sold, just has this wealth. Next year, another 7 billion. So let's say Jeff Bezos from age 65 to 85, he just does nothing but abide by our tax laws and, probably has to sell stuff off over the years to pay that wealth tax. And then when he's 85, 20 years after he retired, he still has about $18 billion left. So during his retirement with no income, he wrote the IRS checks totaling $82 billion and then he dies. And then his estate under the Bernie plan will pay a 77% estate tax. So between at age 65 until age 85 when he dies, more than 95% of his wealth, his estate, what he owns, will go to the IRS. Now, maybe you think that's a good thing. Maybe you think that's a bad thing. I'm not here to judge. This isn't really a political discussion. I'm going to leave that to you guys in the comments below. But that's one of the effects on the wealth tax. And like it or not, what it's probably going to do is, if this ever happens, and who's to say it will, but if this ever happens, yes, there will be a significant amount of revenue collected, but over time, who's going to want to work their butt off and go through all of the BS that's involved to build what you've got to build and deal with all of the government regulation that will exist to even attempt to get it up to that much so you could pay the exorbitant wealth tax? There's just not going to be billionaires to fund all of the programs that are being suggested that that we have. And so I just envision kind of the whole thing would collapse. Now, another issue with the wealth tax is, I have dealt with the estate tax for 29 years. And so have had to help families as a family member passed away. They had some wealth. We had to get assets valued, appraised, reported, tax paid, IRS scrutiny, because valuations can be, depending upon the types of assets, it's really subjective. How much is someone's privately owned business worth? How much is this 27% interest in this partnership that owns X hundred or thousands of acres of land? How much is that worth? It's subjective. So, and it takes really takes the IRS currently on an estate tax, it takes typically years to go through the process of, resolving an estate tax matter. Now under the Bernie plan, we're talking about people's estates having to be valued on an annual basis. And most of the people who have accumulated wealth, they don't just accumulate stuff that is, that the fair market value of which is readily ascertainable. They don't all own just publicly traded stock, or they don't just have bank accounts where you can look at their bank account balance and assess the tax that way. It's complicated to determine, the fair market value of things like businesses, which is what this tax will basically be on, successful business owners. Now, there is a provision in Bernie's on Bernie's website that talks about, hey, under current law, the IRS is already required to assess the net worth of the wealthiest Americans when they pass away to calculate estate tax liability. A federal wealth tax would require the IRS to make the same assessment on an annual basis for the wealthiest Americans. Step would also be taken to streamline the process for purposes of the wealth tax. One more paragraph, which is like 2 sentences, but I get a kick out of this one. For assets that are difficult to appraise, businesses, again, privately held businesses, land, partnerships, various other things. The Treasury Department would have the option of allowing taxpayers to have appraisals done periodically instead of annually. The Treasury Department would establish the average rates of appreciation for several classes of assets. Those appraised only every few years would be assumed to appreciate in the intervening years at the average rate established for their designated class. Okay. So, business owners can get their business appraised every year, report it, have the IRS argue over it. I won't be able to make any more of those videos because too many people are going to need my services. But, or the business owner can get their business appraised periodically, and then the IRS can just assume that their business will appreciate every year under the rate of return or average that the IRS says that your business and your estate is likely to appreciate in value. So just a lot of craziness there. I can't even imagine the government trying to, create the compliance and enforcement divisions to oversee this wealth tax. It's just really, really difficult. Again, not a political discussion, but just really the purpose of this is really just to introduce you to the concept. Maybe you didn't even know that this wealth tax, which is something that has never existed before, is even being proposed. So just found it interesting, a little bit different video because I usually talk about current strategies that you can take advantage of right now, but with all the political debate out there, I thought I'd take a little bit closer look at the potential Sanders wealth tax and be able to share with you some of the details. Okay, so make sure you subscribe, hit the notification bell, thumbs up are awesome, comments feel free, political or otherwise, and tune in every 10 a.m. Central Time every morning. New educational videos on estate planning. Y'all have a great day.